We are not here to spare anyone's feelings. That is not the point. The point is this: will you have money when you turn 70, or will you not? Because in the world of finance, some mistakes can be fixed, others cannot. A major mistake made after the age of 50 is not a learning cost like a mistake made at the beginning of a career. It directly means a lower standard of living, the loss of independence, and becoming dependent on others. There is a fundamental distinction that Robert Kiyosaki has repeated for years. When you are young, growth matters. When you are mature, survival matters. This is not a romantic statement. It is a mathematical fact. You can lose 40% at the age of 30. Time is on your side. You can lose 40% at the age of 40. It will be difficult, but you can recover. If you lose 40% at the age of 55, the concept of recovery no longer exists. There is only damage control. The financial industry knows this very well. That is why investors over 50 are ideal customers for the system. They have savings, they are anxious, they have little time, their fears are big, and fear is the easiest emotion to monetize in finance. One of Kiyosaki's harshest criticisms is directed exactly at this point. The financial industry is not designed to make you rich, but to extract money from you on a regular basis. This sentence may sound rude, but cold reality is rarely polite. Most of the mistakes people over 50 make come not from ignorance, but from psychology. Fear of missing out, panic about protecting against inflation, the desire to make one last big hit, the obsession with not becoming a burden to their children, the inability to admit they made a wrong decision. When these emotions come together, what emerges is not a rational investor, but a person making decisions under pressure. And the market loves people under pressure. This is exactly what Kiyosaki has opposed for years, turning investing from a mathematical problem into an emotional one. After the age of 50, the purpose of investing is not to become rich. The purpose is not to become poor. People who do not understand the difference between these two goals end up using the same words but reaching completely opposite results. A young investor thinks like this: how much can I make? A mature investor should think like this: how much can I lose and still survive? As long as this perspective does not change, the names of the assets in the portfolio do not matter much, whether they are stocks, crypto, or real estate. Risk is not in the name of the asset, but in its weight within the portfolio. There is another point Kiyosaki often emphasizes. People think they are buying assets, but most of the time they are buying liabilities. This misconception is especially dramatic when it comes to real estate. We will come back to that shortly. But first, we need to talk about a more fundamental problem. Most investors over 50 believe they are playing the same game as professional investors, but the game is not the same. The field is not the same. The rules are not the same. For Wall Street, a 20% loss in a portfolio is a quarterly report. For an individual investor, it is their standard of living. When institutional funds lose money, they raise capital. When individual investors lose money, they start cutting back on their lives. That is why Kiyosaki's warnings usually come down to this: older people do not need to play the game that young people play. Here, age does not mean biological age, but financial time. As your remaining time decreases, your capacity for risk also decreases. This is not a choice, it is arithmetic. And at this point, the most dangerous thing appears: hot sectors, technology stocks, artificial intelligence startups, electric vehicle companies, next-generation defense companies, the space industry, crypto projects. The media constantly highlights these areas. Social media fills up with success stories. Everyone talks about how someone got in early and became rich. No one talks about those who got in late and became poor. Kiyosaki has said many times, if everyone is talking about an investment, the opportunity is already gone. Because in markets, money is made before the noise. After the noise starts, risk is transferred. A 50-year-old investor buying Nvidia at the top is not investing. It is providing exit liquidity for someone else. You may find this harsh, but the financial world is not soft. The statistics are brutal. The vast majority of individual investors underperform index funds. That means they take risks, they experience stress, they lose sleep, and in the end, they earn less. This is not a problem of intelligence, it is a structural problem. Professional funds. Access information earlier, trade at lower costs, diversify risk better. Do not form emotional attachments. Compensate for mistakes through systems. Individual investors, on the other hand, hear the news later, buy more expensively, sell in panic, take losses personally, do not have time to recover. For this reason, it must be said clearly, aggressive stock picking after the age of 50 is not investing, it is gambling. The word gambling may be uncomfortable, but its definition is clear. Putting money that is vital to your life on an outcome you cannot control. Now let's come to crypto. Is Kiyosaki completely against crypto? Number. But he is against this, marketing crypto as a retirement plan. Crypto is, by its nature, extremely volatile. This is a technical view, not an ideological one. In an environment where an asset can lose 80% in a single year, it is impossible for a 55-year-old to sleep comfortably. The core problem here is not technology, it is time horizon. For a 30-year-old, an 80% loss is a story. For a 60-year-old, it is a disaster. This distinction, often emphasized by Kiyosaki, is important. Young investors look for opportunity. Mature investors look for stability. The crypto market does not produce stability. It produces volatility. Volatility is a tool for young capital. It is a threat to old capital. But the human mind does not work this way. People see this. Someone became rich from Bitcoin. They do not see this. Thousands lost quietly. Quiet losses do not become news. Quiet bankruptcies do not become YouTube titles. And this is exactly where the financial industry steps in. It sells you hope. It sells you stories. It sells you the sentence, "This time it's different." The structure Kiyosaki has criticized for years is this. The risk belongs to the individual. The commission belongs to the intermediary. The advisor wins. The platform wins. The brokerage wins. The tax system wins. There is only one loser, the investor. And as age increases, the luxury of losing disappears. The summary of everything we have said so far is this. After the age of 50, the investment game changes. The rules change. But most people do not want to accept this. Because accepting it requires accepting one more thing. You are no longer young. And if you are not financially young, you cannot carry the risks of the young. Now we come to the most controversial area. Real estate. This is the subject on which Kiyosaki is most often misunderstood. He is not against real estate, but he is strongly against the idea that it is the right investment for everyone under all conditions. And he draws attention to a classic mistake, especially among people over 50. Tying all savings to one or two properties. At this point, most people think, a house is tangible. It won't disappear like crypto. It won't crash like stocks. This is psychological comfort. It is not financial analysis. Real estate is not liquid, requires active management, requires maintenance, requires taxes, requires insurance, carries tenant risk, depends on regional economic risk, depends on interest rate risk, but you will not find these things written in brochures. In brochures, you see things like this: passive income, lifetime rent, nothing beats bricks. This is where Kiyosaki's famous line comes in. If a house does not put money in your pocket, it is not an asset. Many people over 50 buy property with the dream of rental income, but they do not calculate cash flow. The roof needs to be replaced. The boiler breaks down. The tenant moves out. Taxes go up. Interest rates rise. The neighborhood loses value. And suddenly, the property that was bought as passive income turns into an active expense. For a young person, this may be a lesson. For an older person, it is a collapse. Moreover, the biggest problem with real estate is this: you cannot sell it when you need money. You can sell stocks, you can sell bonds, you can sell fund shares, but you cannot sell a house in one day. An emergency medical expense comes up. The market is slow. There are no buyers. You are forced to lower the price, and suddenly the savings of many years lose value because of a lack of liquidity. That is why Kiyosaki says this: real estate can create wealth, but if it is held the wrong way, it creates poverty. Concentration risk is especially high here. If 70% of your portfolio is in a single property, that is not investing. That is betting. An investment after the age of 50 should have three characteristics: diversified risk, high liquidity, and low stress. If one of these is missing, that investment was chosen emotionally, not mathematically. And emotional investments have always been expensive throughout financial history. As we come to the end of the first part here, let us be clear about one thing. This is not meant to scare you. It is meant to show reality without romanticizing it. A significant portion of investment mistakes made after the age of 50 come not from choosing the wrong assets, but from choosing the wrong products. One of the areas Robert Kiyosaki has criticized most harshly for years is exactly this: the financial products industry. Most of the complex products packaged by banks, insurance companies, and investment advisors enrich not the investor, but the system that sells the product. High-commission retirement insurance products are the most typical example of this structure. On paper, they look attractive. Phrases like guaranteed income, lifetime payments, and protection from market risk are used. For someone over 50, these are psychologically very powerful messages because they directly target fears. People are tired of volatility, afraid of making mistakes, and worried that their money will not be enough. At exactly this point, the advisor steps in and presents a complex contract with a promise of safety. But mathematics speaks differently. In most of these products, the upfront commission ranges between 7 and 10%. That means that in a product entered with $500,000, $40,000 disappears into the system on the very first day. This money does not go into the investor's account, is not added to future returns, and is not recovered. It is a direct loss. On top of that, there is a lockup period. 7 years, 10 years, sometimes more. During this time, the investor cannot touch their money, or if they do, they pay heavy penalties. A health problem arises. An emergency occurs in the family. An economic crisis happens. It does not matter. The system protects the contract, not the investor. This is why Kiyosaki describes these products as legal but structurally unfair. The investor takes the risk, gives up liquidity, and often is not fully protected against inflation. The advisor, on the other hand, earns their money on day one. There is no risk, no uncertainty, no waiting. From this perspective, the summary of this system is this: the risk belongs to the investor, the reward belongs to the intermediary. The biggest mistake an investor over 50 makes is confusing complexity with safety. In the financial world, complexity is often the enemy of transparency. What is simple is understandable. What is understandable is auditable. What is auditable is controllable. That is why Kiyosaki's approach is clear and strict. Do not invest in a product you do not understand. If you cannot explain a financial product in 3 sentences, that product was probably not designed for you. Another major trap is leveraged ETFs and options. These tools look technically sophisticated. They promise high returns in a short time. YouTube is full of videos about weekly income strategies, passive options income, and getting rich with leverage. However, the mathematical structure of these instruments works against the individual investor. Leveraged ETFs are rebalanced daily based on daily returns. This causes the value of the fund to erode over time as markets fluctuate. Even if the underlying index stays flat, the investor can lose money. With options, the time factor works directly against the investor. A small move in the wrong direction can wipe out the entire position. Professional traders use these tools for risk management. Individual investors use them for hope management. The difference is devastating. For someone over 50 to enter these instruments means handing over years of savings to a few weeks of volatility. The issue here is not knowledge, it is time horizon. For a 30-year-old, this is an experiment. For a 60-year-old, it is an irreversible mistake. Kiyosaki's position on this point is clear. Leverage is for young capital, not for old capital. Let us return to real estate. In the first part, we talked about structural risks. In the second part, we need to address a more critical point, concentration risk. Many people over 50 tie all their wealth to one or two properties. They think this is diversification. In reality, it means tying everything to a single region, a single market cycle, a single interest rate environment, and a single legal system. An earthquake happens, the region loses value. Interest rates rise, buyers disappear. New taxes come, cash flow deteriorates. The tenant stops paying and legal proceedings begin. None of these risks are theoretical. They are concrete events experienced by thousands of people every year. But they are not talked about in brochures or seminars. There, only passive income is discussed. Kiyosaki's real estate approach is actually very clear. A property that does not generate positive cash flow, whose debt is not structured properly, and that by itself makes up a large portion of the portfolio is not an investment, but a financial liability. From this point of view, the issue is not buying real estate, but the weight of real estate in the portfolio. A 10% share is a manageable risk. A 70% share is financial suicide. Now let us come to the main question. What should someone over 50 do? The answer is not exciting, but it is safe. A simple, low-cost, broad-based structure. Broad market index funds, because you invest not in a single company, but in the overall economy. Bonds, because they generate income and reduce volatility. Cash, because crises always require liquidity, and if appropriate, large, established, dividend-paying companies, because they provide cash flow. This structure will not make anyone rich overnight, but it will not make anyone poor overnight either. Kiyosaki's aggressive approach for young investors and defensive approach for mature investors is based exactly on this. When you are young, you attack. As you age, you raise your shield. In other words, you play attacking football at the beginning of your career. You play defense at the end. What separates successful retirees from unsuccessful ones is not how much they earned, but how little they lost. Which traps they avoided. Which shiny promises they said no to. The most common regret in financial history is this: I wish I had been more careful. No one says, I wish I had taken more risk. Those who say that are either young or have not yet experienced a major loss. The final test is simple and fully aligned with Kiyosaki's philosophy. Can I afford to lose this money? If the answer is no, then that investment is not suitable for you, no matter what its name is. Stock, crypto, real estate, fund, startup, it does not matter. Retirement is not a game of hitting home runs. It is a game of reaching The finish line without collapsing. The market does not care who you are. It does not care how old you are. It does not care about your plans, your children, or your fears. Mathematics works, probability works, time works. Those who are prepared survive. The others produce excuses. Your 70-year-old self will live with the results of the decisions you make today. Either you will say, "I'm glad I was careful," or you will say, "I wish someone had warned me." At this point, the choice is yours.